Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, 7 years and running, as voted by the readers of the Lake City Reporter. They are the team from Gulf Coast Financial Services, and founder and CEO John Kuykendall leads the way here on Financial Focus each week, keeping us focused, helping to clarify and uncomplicate the financial world. And John, as we are reeling toward the end of the year here, we love to be in the holiday spirit, but there's still some things that we've got to pay attention to and keep in mind for our planning purposes. And today, talking a little bit about inflation and then some of the government response to inflation.
Well, that's right, Peter. There are some things we need to do here as we get to the end of the year. I mean, I know it's the time to celebrate Thanksgiving and all that's going on, how we have celebrated. And, going into Christmas, we just need to make sure that we finish out the year with some things that we need to look at.
Well, this is the time of year where we can get distracted, but we have had a lot going on. We can't let our financial well-being fall on that priority list. So this week we'll cover a few basics, few ideas for next year, some relevant need-to-know information. Stay tuned, as always, lots of important information coming your way. And as always, if you've got specific questions or concerns that you would like to address, end 2021 on the right foot, start 2022 on a good path, pick up the phone and call your resource, Gulf Coast Financial Services, 386-755-9018. That is 386-755-9018. You can also visit online, gulfcoastfinancial.net, gulfcoastfinancial.net. So as we wrap up 2021, obviously a lot has happened in the financial world, but perhaps the biggest story of the year, John, has been the inflation that we have seen. That's been the buzzword that we have heard over and over. Has not been too much of a factor for maybe the preceding 10, 15, 20 years. Yeah. But all of a sudden, here it is rearing its ugly head, and we've got to deal with it.
Well, Peter, I think this is the most inflation we've had since, that biggest increase in our Social Security, as we'll talk about in a little bit, in 10 years or longer. And so it's been a while, going back to the 80s when we had hyperinflation, that we were really, you got a lot of talk about inflation and its effect. But I can tell you right now, if everything you buy, you're seeing inflation and you're seeing it cost more of your retirement dollars to buy those goods that you bought last year, gas prices, food prices. In addition to that, we're still seeing the supply chain problems. It's the first time I can remember in America where we could go to a store and not get what we wanted.
Well, we all remember the green guy who lived up the hill in the Dr. Seuss book that stole Christmas from the Who's. But is inflation going to be the Grinch this year?
Well, inflation is a Grinch. I mean, if you look, starting next year, we're getting a 5.9% increase in our Social Security checks. So our checks are going up. But at the same time, the government is taking 14.6% out of our checks to pay for our Medicare Part B. And for those of you who don't realize this, every time we get an increase in our Social Security check, a cost of living increase, it will cause our Part B premiums to go up due to one of our former presidents who had Obamacare. And he set it up so that we are responsible as seniors for 50% of the losses in Part B. So every year, and Part B loses money every year. So every year we get an increase, they get an increase. And so we're going to have to live with that going forward.
It seems like in the news cycle, they only focus on one part of that. They're throwing confetti and blowing noisemakers for the 5.9% Social Security increase, which, albeit,
big number,
will help with seniors and those that rely on Social Security for all or a part of their income. That is a large increase, one of the largest historically I think that Social Security has seen. 5.9% increase next year. But on the other side, John, what they don't really talk about is the fact that the Medicare Part B premiums are linked to that and are going to go up by 14.5%. So even though it's a smaller number, a much larger increase.
Well, sure, Peter. And so, the government giveth and the government taketh away. Now, it will help some people because if you're on Medicaid or you're living solely on Social Security, there's a good chance that you're not paying for Part B anyway due to a government subsidy. But for those of us who are paying the premiums, it will go up. And this also causes the part that we, for those that make more money, it will cause theirs to continue to go up also by the same proportionate amount. So we're really not getting anything with this increase for those of us that are paying for Part B. It's the largest increase I think we've had in Part B. You got to remember that in the 80s, Part B was $33. So we've come a long way to $170.10.
Yep.
So come a long way since then.
Yeah. Well, and that's the premiums. The deductible also has gone up. So when you are just paying for the routine cost of care on an ongoing basis, that part going to be higher, probably just deducted from your Social Security. But when you actually have something go wrong, the deductible also going up by that 14.8% as well. So I think you put it very appropriately. The government giveth on one hand, they taketh away on the other. Medicare premiums and Social Security, they have made adjustments there for inflation. These are inflation-related adjustments. They also recently announced, the IRS did, that they were actually making some inflation adjustments to the tax brackets themselves. This may be something, John, that gives us a few extra dollars or wiggle room within our current bracket, possibly paying a lower rate.
Well, that's true, Peter. Just for an example, the 12% bracket used to be, it was 12% for anything over 10,275 or 9,950. This year, going into 2022, it's going to be 10,275, and it goes up there. So certainly, if you haven't looked at your taxes and done an evaluation lately, once you get your taxes done this year, we need to look at the 2022 brackets and see if we have wiggle room for a Roth conversion or see how much you're going to be paying. You may have to make some adjustments to your W-2.
Well, the standard deduction will have an adjustment. That's going to be something that I think is helpful. But what I did notice about this announcement of the new rates, John, because of our progressive tax system where each bracket incrementally pays a higher percentage, they adjusted each bracket. So those falling in the lower bracket, the 12% bracket, the bottom threshold only moved $300, a little less than $300, where the highest bracket, they actually got about $6,000 of additional wiggle room. Every bracket got a little bit more and a little bit more wiggle room as you went along.
Well, that's right, Peter. And so that's one reason that we need to look at those taxes at the end of the year and make some adjustments for next year. Certainly, that's something we need to do. And the standard deduction goes up to $25,900 next year versus what it was this year. So certainly some things that we need to be aware of. And as you know, that's one of the things that we do with our clients here. We try to do proactive tax planning so that we can help them do the best job with their taxes. We want to pay to the government what they're due, but we don't want to give them any more than we have to.
And that is through that planning process, formulating that financial focused retirement plan, that written retirement income plan. John, you're not looking at it just from the assets and the investments, nor simply the stream of income that we can create from them, because it's not what we make, it's what we keep. Looking at from a tax standpoint as well, proactively to help your clients and savers and investors across North Central Florida keep as much of their money and their income as possible.
Well, that's right, Peter. And, because of inflation, it's going to take more dollars tomorrow than it took today. And so what that means for people, if they're on a retirement income, they have less dollars to go forward. We want to make sure that we've got everything in the plan looked at, and taxes are a big concern. I think that a lot of people overlook, Peter. I think they just don't spend enough time analyzing or letting us analyze their tax bracket and then work with them.
Well, another thing that apparently doesn't get heavily analyzed are some of these bills that Congress and those up in Washington choose to pass. The Build Back Better. Now, a lot of this was stripped out. It's basically only half of the original proposals here. However, it's still a monstrous bill, and another one of these things where they said they needed to pass it to even know what was in it. So maybe not doing enough due diligence on the front side, but it does look now, John, like this is the 2021 Christmas gift for us from Washington. 2019 was the Secure Act. 2021, here comes the Build Back Better. There are some things that we're going to continue to need to sift through and sort and decipher from this bill that will probably impact savers and investors and retirement dollars.
Well, that's true, Peter. The focus, I think, for the administration and for the press releases so far has been that it affects the ultra wealthy, the people over $400,000. But there are some things in there we need to take a look at, and that will affect everyone and middle class Americans also. And so we need to be aware of that. As you said, this bill has been stripped way down from what they originally planned. Originally, I know a lot of people were upset about the bank reporting. It was thought that, any transaction at first over $300 was going to be reported. And then they changed it to $600, which I can't understand how the IRS would ever go through all that. But that was eliminated and taken totally out. So if you got caught up with those hype emails about get your money out of the bank, or we've got a better place for it, forget about that. It didn't happen. That's not part of the bill. And we need to make people aware of that. There was a big marketing campaign around that reporting that the government was going to take your money from you.
Yeah. I saw a lot of those, heard a lot about that from folks that know I do these programs, asking me questions of if I knew or understood anything about that. And yeah, I think that it was a means to track transactions. They seem to want to do that, but it was overhyped as a government confiscation control. The reality of it, John, however, is that if they want to confiscate our wealth, they have tipped their cap and shown us how and where they'll do that, because IRAs and retirement accounts definitely were targeted. For right now, it was just of those ultra wealthy earners, or mega IRAs as they call it, but through that, the government definitely indicated where they are viewing as a target for potential tax revenue.
Well, that's right, Peter. I think the changes we've seen in the regulations on IRAs and Roth IRAs shows where we're going in the future. And I think that's one reason that you're going to see that life insurance and some other products are going to be a lot more in demand in the future because they are taxed free. Like I said, it was mostly made because of the ultra wealthy, but it will affect a lot of people. We had our first actually inherited IRA this week that fell under the Secure Act. And so we were sitting there trying to explain to the people why they couldn't stretch the balances out. And even with the Roth, we have to take that out over 10 years, which it could pass forever. Well, now we have to do that for 10 years. So the Roth's still tax-free, but we got to get it out and put it into a brokerage account so we can get it taxed then going forward.
And these things that we need to stay current on to understand how our money's going to work for us and the effects on those dollars that we've worked so hard for during our lifetime and beyond. And that's the type of planning that they do there at Gulf Coast Financial Services, staying on top of these changes and these updates and then all of the forces and factors in the financial world so that you can use your money with confidence to support what you find important and know that the plan is there to continue being able to do that. Pick up the phone and give John Kuykendall And Gulf Coast Financial Services is a call for that financially focused retirement income plan. 386-755-9018, 386-755-9018, 386-755-9018. John, I wanted to leave just a few minutes in the program to talk about this checklist. Santa's got his list. He checks it twice. You guys there at Gulf Coast Financial Services have your 2022 financial and retirement planning checklist. It's looking at things we need to do or pay attention to with income, with investments, with taxes, with healthcare, and with legacy, and then some milestone dates that we should also be aware of and pay attention to.
Well, that's right, Peter. We'd be glad to get that out to anybody out in the audience that would like to have it. It's certainly something we could send to them. But, there still are some things that we need to do. And on this checklist, I think one of the most important is to make sure you've maxed out all your retirement account contributions for this year so we can get the tax benefits. Also, if you're making Roth contributions, we want to be able to make sure that we max those out to get the most in there. Also, don't forget that we've had a couple of tremendous years here. And if you haven't in the market, if you haven't made some adjustments to your portfolio does not reflect your risk tolerance. And so we need to rebalance and rebudget some of those items. And also, we just need to look at our income and our expenses. I was doing some planning yesterday, believe it or not, with a 38-year-old who wanted to see what it would take if she retired at age 65. And one of the hardest things I had to explain to her was that at her salary level, what she needs now, which is about $100,000, at 2.5% inflation, when she retired at 57, which is what she wanted, she was going to need almost $200,000 in income just to keep current with what she wanted today. So, people need to be aware that portfolio needs to be able to make the most money we can for us because we're going to need the income. But there are some key events here we need to worry about. At 55, you're eligible for a 72T on your 401k. And if you don't understand what a 72T is, give us a call. We can explain that to you. 62 to 70, you're eligible for Social Security. 59 and a half, which is a good number, you're eligible for an in-service distribution and penalty-free retirement account withdrawals. So that if you're in the company and you want to diversify, you can take your money out without penalty and roll it over into another IRA.
And keep on trucking along, keep on plugging away, continue working and participating in that 401k. But they have that set menu of 10 to 20 options that you have available to invest in. Whereas if you roll that account out with that in-service distribution at 59 and a half, you've got the full spectrum of the financial world, far more choice, far more control. You can begin to do some proactive tax planning and structuring of those assets to an option that may be better suited for retirement.
Well, we can look at long-term care. We can look at guarantee, income coming in. There are certain things that we can do when we get that money out at 59 and a half, and certainly is something we want to do. And also, listen, if you haven't taken your required minimum distribution for the year, you need, and you're over 72 or over, you need to do that now. Yeah. Because it's a 50% penalty if you miss it. And I can tell you that the IRS finds that quicker than anything.
Yep. Well, we don't want to give the IRS any more than necessary. Each one of our dollars we've worked hard for. I know that there are certain instances where there's a partnership arrangement with the IRS on those tax-deferred accounts, but they do expect a minimum payment at a certain point in time. Required minimum distributions are the way that they collect that if they have not otherwise seen those dollars they are owed, and we don't want to miss that because there is a penalty for late payment or missed payments. So if that is something that's unfamiliar to you, if you are over 72 or 70 and a half before 2019, basically if you're born in 1949 or before, or know anybody who is, absolutely something. We are basically last minute on this because it has to be completed by the end of the year. So let's get a jump on that. Pick up the phone, give Gulf Coast Financial Services a call if you need any help or assistance or further education. If you've got questions or concerns of your own, if you'd like to look at that written retirement income plan, that financially focused retirement plan, 386-755-9018. That's 386-755-9018. If you'd like the financial and retirement planning checklist for 2022 and beyond, it's a great resource just to go through on your own time, make sure you've addressed these items, or if you're hitting these milestones that you understand what they mean for you. So if you'd like that, again, just give a call, 386-755-9018. John, always a pleasure, and because we probably won't talk to you before then, Merry Christmas and a Happy New Year to you.
Merry Christmas to you and your family, Peter, and everybody out there listening. And I want to say, stay tuned, because there are more changes coming, and we will have those on here as we talk about the new tax changes in 2022.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.